Whoa, markets are at all-time highs, but you're still nervous, aren't you? Every headline screams AI bubble or credit crisis, and you're wondering if it's time to sell. Today, I'm going to drop the truth about why long-term investing isn't blind faith, it's strategic endurance in manic panic. Guess what? Inflation might not be as bad as we all thought. The Fed is cutting interest rates. President Trump is about to meet with President Xi. Trade tensions might be easing. Fiscal stimulus from the One Big Beautiful Bill Act is about to add some juice to growth. Earnings season has been pretty good so far, even exceeding my 8% EPS growth target. As of 6 a.m. this morning, we're seeing 15% aggregate year-over-year growth. That's pretty good. Everyone's favorite Mag 7 megacaps are set to report this week, and they'll likely remind us that AI isn't just a fad. The naughty guys and gals in Congress will eventually play nice, because even they get bored of doing nothing. So why aren't you celebrating? The S&P 500, the Dow, and the Nasdaq all closed at all-time highs, and yet you felt uneasy, maybe even queasy. Well, you're not alone. You're nervous. You might remember your portfolio getting crushed back in 2008, don't you? Now, headlines are screaming about an AI bubble or a hidden credit crisis, and people are telling you everything's fine. But you go to the grocery store and your bill makes you want to scream. The average car price in America just topped 50 grand. Target announced 1,000 corporate layoffs, and Amazon, second only to Walmart in the US employment, is rumored to be cutting 30,000 jobs. AI efficiency is starting to sound like code for people losing their jobs. But private data sources like Bloomberg Economics confirm that the labor market is still getting shaky. So what now? Is this the beginning of another great recession? Will the AI bubble pop? Should you sell everything and then hide under a rock? Well, that's the old fight or flight instinct talking. It hits you right as you open your brokerage app and see markets up another 2%. Yet, for some reason, you don't feel richer. You feel suspicious. You know that markets don't give without taking back. But that fear, that urge to do something, is the exact emotion that destroys portfolios. The S&P 500 has survived world wars, oil embargoes, terrorist attacks, global pandemics, and now this era of tariffs, AI, and political circus. And through it all, it has compounded wealth about 10% per year. Not linearly, but comfortably and relentlessly. The data is clear. Staying investing always wins. It just doesn't feel like winning while you're in it. It feels like swimming in open water with no buoy in sight. Tides dragging you under, waves smashing you in the face. But those short-term waves, rate hikes, trade wars, AI layoffs, they're designed to test your conviction. Conviction, you see, is what separates investors from gamblers. I've seen this move too many times in my career. People panic, sell into weakness, and then wait years for the right time to re-enter. By then, unfortunately, the markets have made new highs. It's not the headlines that ruin your portfolios, it's human reaction. Investors claim they're long-term until the market tests that theory. Then they turn into day traders and economists and doomsday preppers all at once. Staying invested doesn't mean staying lazy. It means staying smart. Volatility is the price for admission for the privilege of compounding. The market doesn't reward heroism. It rewards patience. That looks a little bit like courage in hindsight. But patience doesn't mean inaction. It means doing the work. Recheck your thesis. Reevaluate what you own and why. Separate companies with real earnings power from those riding the hype. Conviction is belief based on evidence. Stubbornness is denial of new data. If you're holding hope stocks instead of cash flow stocks, well, it's time to trim, not to torch everything. High-quality companies with strong balance sheets and pricing power survive. They're not flashy, they're resilient. That's where you hide during storms, not in cash. Cash feels safe, but safety isn't security. You can earn 4% in a treasury bill and sleep soundly, but in 10 years, you'll have lost to inflation and taxes, while the market grinds higher. The rally you fear missing is being built right now while you're too afraid to even look. Saying, I'll wait until things settle down is like saying, I'll go to the gym when I'm in shape. The market moves when uncertainty is peaking. That's when real returns are made. Look at every 5-year window after a sell-off. Investors who stayed in or rebalanced into weakness ended up ahead. Those who sold missed the rebound. The hardest times to buy are the best times to buy. Even when the world felt like it was ending in 2022, the S&P still delivered 40% in the 5-year period prior. If you got cold feet, you missed nearly 100% gain in the next 5 years. That's the cost of fear. Being in doesn't mean being indiscriminate either. This isn't about blindly holding everything. It's about allocating intelligently. Know which companies deserve conviction and which ones deserve pruning. Do your homework. Write down your thesis for each stock. Ask yourself, would I buy this today? If the answer is no, well, then reassess. If it's yes, then maybe consider doubling down, rebalance, review, but don't retreat. Investing long-term isn't about perfect timing. It's about managing imperfection. The edge belongs to those who stay adaptable and honest about risk. Remember 2008. The world felt like it was collapsing. Portfolios were down 40+%, but the S&P doubled in 5 years, then doubled again. Those who stayed won. Those who left missed one of the greatest wealth creation runs in history. Today's market is no different. Yes, we have inflation hangovers, tariff uncertainty, and technological disruption. But we also have innovation, productivity, and policy support. Your job isn't to predict, it's to prepare to stay in the game. Staying invested isn't blind faith, it's strategic endurance. You don't sell the boat because of rough seas, you adjust the sails. The only people who drown in markets are the ones who jump overboard. Markets climb walls of worry, not walls of certainty. When everyone agrees it's safe, it's probably already too late. What matters right now is not if you feel good, it's whether your plan is good. The call from your gut to sell everything is really a call to understand everything. Look at your portfolio like a coach looks at a team. Some players are stars, some are role players, and some need to be benched. You don't fire the whole team. You make adjustments. That's how you win championships. The market rewards those who play every quarter, not those who try to time the final whistle. Long-term always wins because time is the one advantage that really never runs out, unless you surrender to it. So don't get out. Get smart. Recheck your assumptions, resize your risk, and keep on moving. The best investors don't predict storms. They build boats that can handle them. The worst ones stand on the dock waiting for calm seas that really never come. The difference is discipline. Let the Fed cut. Let politicians do their ranting. Let headlines scream. You can't control that. What you can control is how you think, how you allocate, and how you react. The market doesn't ask for heroism, just homework. So your truth bomb for today is this. Long-term always wins, but only if you stay in the game, my friends. Join me every day for Wall Street Truth Bombs, where I drop them here before the market figures them out.